Good morning and welcome back to Day 2 of the India Investment Forum. Yesterday we learned about the opportunities in India, along with some of the characteristics of the market that make foreign investment leery. We also heard a delineation of the changes that would need to come to attract the level of investment that India warrants. Throughout the day we heard a constant theme of hope and optimism and expectation that Prime Minister Modi can deliver these changes. Today, there's a logical progression of sessions, starting with the asset management sector, moving to banking, and then where India fits in the international investment landscape, and culminating with a robust discussion of what India needs from the world and what the world can expect from India. So to kick it off, we have a keynote session on the growth of India's asset management sector. The chair is Sundeep, Sikka, President and Chief Executive Officer, Reliance Capital Asset Management, and Chairman of the Association of Mutual Funds in India.
Morning, everybody. I think it's an interesting first session. Since yesterday, we've been hearing about India, what's happening in India, and the location of the venue could not have been better. As you walk in, I think you see the Indian flag flying high. From our perspective today, as we're talking about India, it's all about India. This session becomes more important because whatever you learned yesterday, it's important how do you start investing into India. We have a panel which covers both the domestic and the international fund managers, and we have someone with us who will also tell you how to invest into India, how to make the gateways into India. So let me introduce the panel. On my left is Nagu, and I should say at Nagu because in India we call him Nagu. It's Sudarshan Naganath. He represents BlackRock. We have next to him is Harshendu. Harshendu represents Franklin Templeton in India. We have Nishith Desai, representing Nishith Desai and Company, someone who advises a lot of international investors how to invest into India. Next to him is Sunil Singhania, CIO of Reliance Asset Management Company, and the only Indian on the global board of CFA. And next to him is George. George represents State Street, someone who's been looking into India for a long time and trying to look at business opportunities in India. Let me start with you, Harshendu. A lot is happening good in India. India has been talked about since yesterday. I think wherever I went outside the conference also, it's all about India. So seems a lot of good things is happening in India, and same is happening in the asset management industry. So just can you give the audience a little overview what's happening in Indian asset management industry?
Sure. Thanks, Sundeep, and good morning. I think the best way to explain the Indian asset management industry and where we are, especially to an audience in the US, is to take you back to the pre-401k days, where in the early 1980s, and you saw the penetration at that time for the US mutual fund industry was about 8 to 10% of GDP. I think India is in a similar place in that the Indian mutual fund industry is basically focused on getting the discretionary savings pot of the Indian investor into mutual funds. I think we compete in that pot with physical assets, especially gold and real estate, and that's a hot favorite of Indian investors, as well as fixed deposits. And the reason for that is that the lack of awareness about capital markets and generally financial planning in India is relatively low. The Indian mutual fund industry, currently our assets are an all-time high. We are in the range of about 168, 170 billion. And we really enjoy two types of clients. One, retail investors parking their discretionary savings with us, and two, institutional investors or corporates that are primarily focused on parking their excess liquidity with us in the industry. So I mean, that's the stage we are at. The industry is set up very similar to how it's set up in the US in terms of manufacturing, availability of asset classes, in terms of the way distribution is set up, in terms of the split between banks, advisors, and wirehouses. So in that sense, it's quite similar. I think the industry is also very good in terms of corporate governance standards, and I think is known to be a very transparent and well-run industry in India. So I think those are the positives. looking forward, I see a lot of potential for the industry. One, I think the industry has taken head on, and also the regulator and the government, in terms of creating a lot of financial literacy and awareness, and especially awareness for mutual funds as a category. And so there's a lot of effort. In fact, the industry spends 2 bases of all its asset by regulatory mandate on creating that investor awareness. And so as we see rising income levels, we'll see growth of distribution, we'll see an appreciation among the Indian consumer as to how the mutual fund industry can help them with their financial goals. I think the industry will definitely see organic growth going forward. But I also think the industry has 3 other areas which will kind of make that growth accelerate. The first area, I think the industry at some point in time, and it seems logical, will get to manage pension and insurance assets, which currently can't. And I think that as and when that happens, that will be a huge inflection point for the industry, and similar to what happened in the US with the advent of the 401k plans. So that's one opportunity. The second opportunity, I think, for the industry is also in terms of attracting money outside in that Sundeep mentioned there's a lot of interest in India, and I think that interest is there not only on the equity side. I think it's also building up on the fixed income side with the easing of regulations on that side as well. And so I think the industry will have to kind of gear itself up to attract some of that money, and I think that's an opportunity for the industry. And the third area of opportunity I see is in India, I think the high net worth segment is also growing quite well. And we need products to service beyond just the mutual fund products that we currently have, and therefore, the alternative investment fund guidelines that have come out, or the REIT guidelines have come out, I think will help the industry also focus and provide solutions to that segment. And so those are the 3 opportunities I see, and therefore I'm very optimistic about the industry, not only in the near term because of cyclical reasons, but also over the medium and long term due to structural reasons as well.
So good, Harshendu. So there's all over positivity, positive view on India and positive view on asset management industry. That's what you. So let me come to you, Sunil. We have seen, when you look at the data, a lot of mutual fund schemes in India have given a return of in excess of 20-25% over the last 20 years. But still the investors, the domestic investors, have not started embracing mutual funds. What do you think? I mean, what's the reason why they're not coming to mutual funds? I mean, if the returns are so high, and how do you see things way forward?
See, one thing is we have to realize that India is a young economy. We got independence 60 years back. And I think that time our ancestors were focused on meeting their day-to-day needs. And there was no savings, worthwhile savings. Also the habits predominantly were focused on hard assets, which was real estate and gold. And frankly, last 20 years, you are right that schemes have given upwards of 20%, 25% CAGR. But at the same time, there's been volatility. And because the investor awareness has been low, investors have basically, instead of taking advantage of the volatility, got, you can say, impacted by the volatility. So they invariably have ended up coming at very high levels and exiting at the wrong levels. I think what has changed is very clearly we are an economy which is moving towards more education. We have one of the youngest populations. The young earners have significant disposable savings and also awareness about long-term wealth creation. Along with it, what has also happened is that the lure of real estate and gold, which was so strong last 5-6 years, has to eventually come down, and which has already started. And now we are also looking at India with a lot more optimism. So, again, to just give you some figures, it took us 60 years to reach $1 trillion in economy, only 6 more years to reach $2 trillion in economy. And maybe in the next 6-7 years, we would be $4 trillion in economy. And I think once the economy moves, the equity markets tend to do much better. And even from a government perspective, the tax advantages and the incentives towards investing more money in equity, along with the returns, I think that is definitely going to bring investors back. I'd just like to highlight here one thing, that Indian mutual fund industry is now so well regulated and the disclosure norms are so good that investors finally have the confidence that returns obviously will depend on the market, but as far as their capital is concerned, not in terms of the losses not being there, but at least in terms of the practices, the mutual fund industry is one of the most efficient and the best governed, segments of the financial market. So I think all said and done, huge opportunity, and from our perspective, I think we are there.
So do you think, the lure of gold and real estate, will you see people moving to, moving away from bank deposits, gold, real estate, and coming into mutual funds?
See, gold does not give you any dividends or interest. So the only way you make returns in gold, if you find someone else who buys it higher than your cost price. And the prices just can't keep on going up. The other thing is gold is basically an instrument which does well in terms of risk awareness. I think last 5 years, because of what happened in terms of financial market volatility, post-Lehman crisis, there was this lure of gold. I think that is now behind us, and you're already seeing gold prices react in dollar terms almost 30% from their highs. In terms of real estate in India, the yields again are like 1%, 2% per annum, when the interest rates on a mortgage are like upwards of 10%. So the only way you can make money in real estate is continuous appreciation of your real estate. There is again hardly any income yield. There also the prices have reached to such an extent that it's very difficult. The other most important thing is that the taxation is so loaded against these asset classes. So when you buy and sell real estate, you have to pay stamp duty and registration fees. Also, you have to pay big income tax on your gains. Equity is completely tax-free. So any investments over 1 year, you pay 0 tax. And I think on a post-tax basis, that's fantastic. So I think finally, from a longer-term perspective, the time of equity has come.
That's good news if you see money coming into equity mutual funds in India. So, Nagu, we had a domestic view from Harshendu and Sunil.
Sure.
I think you are leading a successful foreign AMC in India. Tell us a little, how do you see what's happening? Are you seeing foreigners looking into India? Are you seeing this money coming into India? What's the trend that you're getting?
Sure. Well, we're seeing a lot of interest amongst institutional investors like pension funds, insurance companies, family offices, endowments in investing in Indian equities and fixed income the past few months. So what is really driving this optimism? Well, for one, I think the expectations are that GDP growth rate has bottomed out. In fact, we believe that next year and the year after, that is fiscal 16 and fiscal 17, we could well see GDP growth rate get back to the 7% rate from the current year's expectations of about 5.7, 5.8%. And we think that incremental growth in GDP will be driven largely by revival of the investment spending cycle, besides, of course, an acceleration in consumption spending. And when you have that kind of an improvement in GDP growth rate, you will also see a concurrent improvement in corporate earnings growth. So indeed, if that number goes from 14, 15% to about 18 to 20%, I think that will underpin strong performance of the stock market. The second is that investors find in India a variety of sectors to choose from. It's not a market that is led by just 1 or 2 sectors. There's a lot of sectors to choose from, and more importantly, I think there's numerous companies across the capitalization spectrum. So you've got large companies, mid-sized companies, small cap companies. So that's what makes the market very interesting. And as far as fixed income is concerned, again, as Sunil pointed out earlier, inflation has been high but is beginning to recede. So we do think there is a high probability that we'll see some interest rate reductions sometime next year. So that will again, underpin some good performance in the fixed income market. As far as equities are concerned, even though the market is up 30% or nearly 30% YTD, we still think it has material upside in the medium term. So I think these are the factors which is sort of leading to a very optimistic outlook amongst foreign investors, institutional investors in particular.
Well, that's good. That's positive news. George, coming to you. You run one of the largest international ETF companies. Tell us a little, you're not in India right now. How do you see the ETF opportunity in India?
Well, let me start out by saying that my firm, which has 2,500 employees, has 500 employees in India. So I deal with the people in Bangalore every day, and it's a pleasure. Let me try to place the opportunities in India within the global context of the ETF business. So the ETF business continues to grow very rapidly. It offers certain advantages of low cost, very targeted. We're now into the, I would say, second and third generation of ETFs, so-called advanced beta, like minimum volatility. But let's take a case of targeting, for example, the Indian small cap sector. This ETF innovation offers to global investors the ability, retail investors, to target a sector that previously would have been more difficult to access. Interestingly, around the world, we're finding more and more institutions using ETFs. So we're at about 50-50 globally. And as you know, within India, so in terms of money coming into India, there's some well-established vendors. And then within India, the market is dominated also by some fairly large players. I would say from State Street's perspective that we view ETF opportunities favorably but cautiously. This continues to be a mutual fund dominated market. I think to get the market going in ETF, one thing we need is better macro policies. As inflation comes down, people will be coming out of gold, presumably, and more into stocks. Better distribution. Some mutual fund complexes left India, I think, some years ago. And then better profitability and investor education.
So good. Nishith Desai runs, I mean, today if you were to see, Nishith Desai and Company is one of the companies which advises a lot of international investors how to come to India. So he's today sandwiched between all the asset managers. And Nishith, how do you see, SEBI's been doing a lot of work to get flows into India, and the recent, if you could update the audience, what is this FPI?
Yeah, first of all, thank you for giving me the last words. Lawyers must have. But one of the best institutions I see in India is SEBI compared to any other one. Okay, and the whole country is complex. We are masters of complexities, and we keep on developing new ones at times. But looks like we are going to be in much better shape today, or at least from now on. We used to have this regime, FPI, QFI, and stuff like that. You know, it was getting a little more and more complicated. You know, in terms of one good thing that has happened is that, in fact, last year, the Chandrasekhar committee recommended that all these hassle-some regulations, let us consolidate and make them. What is the purpose of all these regulations? At the end of the day, you want to know the right investor comes, who has reasonably clean background. You don't want terror money. You don't want other kind of tainted stuff. So KYC was the most important thing. Everyone is concerned about the background of the investors. And I think the new regulations that have been developed are more in sync with KYC, and therefore a new FPI regime was introduced, I believe, on 7th of January this year. And in simple words, I won't complicate, which I usually do. The simple formula here is that there are three categories of investors. Number one, who are generally by definition are supposed to be good investors, the foreign governments, sovereign wealth funds, multilateral institutions, and all those kind of. So they need least amount of KYC. Okay. The second category is where there is some degree of regulation prevails in the overseas jurisdiction on a particular institution. So there are the categories of which are specified, which are regulated entities overseas. Whether mostly the regulated entities means either regulated by the relevant equivalent of Securities Board of India, members of IOSCO, or the banking regulations. So you got this, these two regulators. So you can have those as a second category. Within that, they have also now permitted the regulated entities like fund managers and others who are already regulated to invest on behalf of unregulated entities as well. Okay. Only thing is that they cannot do ODI in that particular category. And then there are some other ones. So there, so to say, first category, least amount of KYC. Second category, some amount of regulation prevails, so SEBI is very comfortable. And third category is unregulated. So anyone from the world can invest in India today. So to that extent, regime has been simplified, okay? And it's everything circles around the KYC norms and some of those things. So basically, now we have an opportunity to go out in the world and get investment. So I expect a lot of investment to come under this category. Only thing, that's on the front end, supply side, if you put. On the demand side, unfortunately, what has happened is that our Companies Act became very onerous in many ways. In some features are very good, some features are not very good. So for example, our company incorporation, the numbers if you see compared to last year, they've gone half. So, you know, from 5,000 companies to say 2,500 or something like that. So it's company incorporation itself has gone down because of the corporate registration. So some of those things are, stopping it. Third one is tax, which I don't need to speak about. The finance minister himself acknowledges that there has been some kind of tax terrorism. But very fact that he has recognized is the beginning of the good days to say that, okay, now I have to address this issue. And there are reasons why tax department acts in a particular way. They have their own reasons, and the investors have their other, I'm sorry, this morning alarm goes on, and sorry for that. So I think tax is a third feature which I think is stopping a lot of investment coming into India. My expectation is the government has just completed about 100 days. Sometime by March, we'll have a lot more reforms and, things. I don't want to go too long on that. But I'm very optimistic that in next 3 years' time, a lot of changes would happen. And in the first year, we'll see little of that. Because there are many decisions which are policy decisions and goes through a number of committees and stuff like that. But I think we should not expect too much before 1,000 days argument to this government. That would be my immediate reaction.
So Nishith, one of the things, everybody's been here for 2 days. They are going to get, I'm sure they'll get excited about India. And if they think they want to invest tomorrow morning, so what happens? What next for them?
Say that again, you missed?
So if they have to start investing into India
Yeah.
tomorrow, so how fast they can invest even if they have not?
See, I say most of the faces are NRIs, and they are excluded from the category of FPI, as you know. So they will have to work under the regular regime.
But what about
But they can bring collective investment pools. I see that, now because the regime has been easy, NRIs through a collective investment vehicle can still come in. That's a different issue altogether. But if they have to come together, either they can pool money, they can come individually, they can come through investment managers and stuff. I think you got some.
Well, I just want to make a point because I think it puts it in context, which is that emerging market mutual fund managers historically have been overweight India, and they're currently significantly overweight India. I'm talking about foreign money coming in. But I do think we have to recognize, as Mr. Rajan himself raised the comments, that we are entering an environment most likely of rising interest rates in the United States. And this may temper to some extent in the short term flows into the Indian asset markets, equity markets. I do believe, of course, from the business standpoint, that the long-term opportunities are very, very significant. But it is a very competitive market.
But what do you think the impact of this Russian syndrome is? A lot of monies that were going on that side would have some overflow, and part of it may come to the U.S. And what do you think implication of this, sanctions and all that kind of stuff?
Oh, the sanctions. Well, most pension funds and sovereign wealth funds are structurally underweight emerging markets. So the home bias continues to be very large, and I think the long-term secular flows into emerging is positive. But as we know, has been discussed, their markets can be very, very volatile, and we do have to recognize that as a twin deficit country, India, is part of the so-called Fragile Five, as has been called, and that investors will be looking very closely at the implementation of reforms. But in terms of the domestic market, particularly as inflation comes down, and that it's attractive. And just one other thing is that if you look over a 10, as you were mentioning today at breakfast, if you look over a 10-year time frame, the Indian market has been an excellent investment, driven by, of course, many outstanding companies like Infosys and others.
In fact, we begin to see a lot of deals, by the way, at this, even private equity and other things.
The interest is increasing.
Yeah.
Yeah, that's good. Okay, my next question is for Sunil and Nago both. We have seen in Indian markets a lot of money which has come. Earlier was coming, is even right now coming through ETFs. But again, as active fund managers, both of you, how do you see this opportunity? Or a lot of investors who would have invested into India through ETFs, do you think for them there's an opportunity available if they were to come on the active side? I think I'll leave it to both of you to.
Yeah, I'll answer that first. And I'm sitting close
Next
to
one,
George.
I'll come. The next question is going to be.
I think, there was a point mentioned that India has a lot more companies which are listed and a lot of smaller sectors which eventually become large. So, we talk about Infosys and TCS, but in early 90s, the market cap of the IT companies was not even 1% of the total market cap. Now they are almost 12-13% of the total market cap. The same goes for telecom companies and some of the other sectors. So I think a lot of sectors in India are just evolving, and they will eventually become large, whether it's retail, e-commerce, and so on and so forth. From a country-specific perspective, I think what is very important is that you are able to some extent invest in these companies or sectors at the initial time. And that is where the big alpha is created, and that is where this 20-25% return has been generated. So ETFs are great instruments, but ETFs will invest in these companies only when they are part of some indices, which might not be at a very early stage. So I think to some extent the alpha generation, which has been clearly proven over the last so many years, will continue over at least a few more years till India matures as an economy, and then maybe ETFs might turn out to be better. So right now, even after paying the fees or differential fees compared to a passive fund, I think active funds are very handsomely beating the benchmarks over 1, 2, 3, 5, 10-year perspective. And I think from that perspective, for any investor, active fund management definitely makes a lot of sense. So I think from our perspective, when we meet investors, very clearly segments which they are not able to invest directly, whether it's mid-cap side or whether it's off the top 10, 15 companies, other than that, that is where the onshore fund managers like us, like DSP BlackRock, would be in a better position because we are on the ground, we have a lot more people there, and we are more closer to where the action is in terms of company meetings and all. And I think that would be the pitch from
Nago.
I think one way to look at it is how big weightage you are according to India in your portfolio. Now, if you are a large global fund with a small weightage, perhaps the fastest and best way to get that exposure is to buy an ETF. On the other hand, if the weightage is significantly larger in the context of a global fund or a EM fund, then obviously the best way to go about it is to, I think, have an active exposure. And as Sunil rightly pointed out, over long periods of time, given the choice of sectors and stocks across the capitalization spectrum, the potential for generating significant alpha is quite high. So I think it all depends on what the weightage is in your portfolio.
So, George, you want to respond to that?
I actually agree, given the breadth in the Indian market, that the number of stocks, that India is a reasonable place to spend a so-called risk budget. And I do believe that there are skillful managers out there, and that, as I say, this is reasonable. I also think that there's scope for both active and passive management, depending upon the individual investors, sort of prior beliefs and overall approach. But as Sunil said, there's no doubt that there are many small and mid-cap stocks which are probably under-researched, which provide the opportunity for alpha generation.
Perfect. Nishith, coming to you, we have seen a lot of private equity investments also coming into India. Mm-hmm. So how do you see this trend? I mean, anything that you'd like to update the audience here?
I just had a meeting on 22nd July in this very hall with about 150 private equity funds.
Okay.
And that itself, we thought we'll have a small room, 60, 70 funds will come and, and we had to really change the room overnight to this period, the ballroom. That shows, and there is tremendous amount of interest in India, number one, at least from my perspective. Where I found some disconnect was in terms of infrastructure investment. There have been some concerns. People are waiting at the door, I think. How quickly we open up the door, how we clean up our system and stuff like that. I think it's going to be more dependent on us now. Like, for example, we all talked about this new circular of Central Board of Directors. It created more confusion than the clarification. So, and suddenly everybody stopped, the domestic AIF, because the approach of many of the foreign private equity funds and the new ones that are coming up, they say we put this money, but India should also have a stake in that. So they want some kind of commitment from Indian side as well. And in the process, we made the environment which was a little easier. Now it became a little difficult. But I think these are hiccups, road bumps, which are bound to happen. But definitely I see a lot of interest in the private equity. More interestingly, we see lots of deals happening, and even large deals and other ones where Tiger or everybody else is investing and even exiting to some extent, So that is another thing that has happened. Suddenly there is fresh air which you begin to see. I have not been so optimistic last 5 years, which I am today. At least being a tax lawyer who sees everything through the eye of operation, like a doctor, everything inside you see, you feel that why this should happen, So we were speaking some funny stuff all these 5 years, and that's the problem. So anyway, coming to the whole thing, that environment is much better today. Deals are beginning to happen, and I think, at least I would like to ask a separate question. All of us said India is a long-term bet. But I want to know each one's definition. What do you mean by long term? 3 years, 5 years, 10 years, 15 years? Because lawyers always start with definitional context. So whenever somebody says India has a long term potential, then please tell me what do you mean by long term? You define. And then I think starting point.
Sunil, you want to define long term for the investors here?
I think long term is as long as you can see the growth opportunity. And I think from an India perspective, we have seen over the last, ever since we opened up in the mid-90s to now, despite all the hiccups, India has structurally kept on growing. So I think from...
I was trying to be a little more objective as to...
If
when
you
you
are
say
right,
long term, because you say long term and I understand something.
If you are right,
I look at long term means income tax, 3 years, right?
On a lighter note, when you buy a stock, if you are able to sell it, it's profit. If you're not able to sell it, it becomes a long-term investment.
That's very clever.
Okay. So can I just, on this point, I think we underestimate the growth of the asset management industry in India. Even in the last 5 years, which generally we recognize is a tough period for the industry, we've actually grown at a double-digit number as an industry. And even in terms of the penetration that we've got as an industry, I think at 8 to 10% of GDP after really 20 years of existence compares to the US took 55 years to kind of reach that kind of penetration level. So I think the industry, clearly the opportunity is a lot more, but I also think the potential is coming through in several ways.
Just to add one small thing, I've seen, because when I set up first fund about 15 years ago for India, today the asset managers have, I think we have excellent pool of talent in India, which was not there 15, 17 years ago. And that gives me little hope that irrespective of whatever things are in India, we'll be able to communicate to the outside world or the domestic investor how to manage this risk. Because once you know that, there's always opportunity. Sorry for interruption.
Harshendu, on this question on the growth that the industry is seeing, I think this is for both you and Nagu. Last 2 days, I've been here answering a lot of questions. It's a tight, difficult question. How are the foreign funds doing in India? People have heard about a lot of asset management companies leaving India. So I think both of you are very successful in what you're doing in India. So just can you, because on this, what are you doing differently? What makes you successful in India?
So I think the first thing to recognize about India is that it is almost predominantly a local asset management industry. If you see the global model of expansion of the asset management industry, they've been leveraging off centralized manufacturing capability, i.e. in Luxembourg and typically the UCITS world, and they've been able to export that in other parts of the world. In India, I think you have to build your proposition from scratch, which is you need to build your investment management capabilities, you need to build your operational capabilities, you need to build domestic knowledge and expertise in terms of getting around the regulatory environment, which is very complex and different than a lot of other players. And I think with Franklin Templeton, the reason I think we are successful in India is we've taken the time to do that. We entered the industry really in the early days. In fact, in the private sector, I think we enjoy the longest track record of all funds. And so we really came in very early. We spent the time integrating in the local environment. And frankly, I mean, we don't even see ourselves as a foreign firm anymore in India. I mean, we are as local as that. And so the way we look at India is think global, implement the best global practices, global standards, corporate governance, best practices in terms of investments, but also act local. Local in terms of understanding the environment, the distribution landscape, and the ability to adapt to that, I think has been very important. And I think we've been able to do that well in India, and I think that's the reason why we are successful as we are.
Good, wish you all the best. Nagu?
Well, I agree with what Harshendu is saying. I think the decision to establish a business, stay the course, differs from firm to firm. But as he rightly points out, you have to take a long-term view, and here I would define long-term as at least 10 to 15 years at the minimum, because you need that much time for the market to really grow significantly, and we've all seen that since the mid-90s. If you look at it today, I mean, we've come a long way in terms of industry growth. And then there are phases when there is very rapid growth followed by periods of consolidation. So I am very bullish that if you look at the next 10, 15 years, the industry probably will grow manifold from where it is today.
I was going to come to you. So, does it excite you to come to India?
Of course. But I would say that one aspect that I think that will propel the growth of the Indian investment management industry is the further institutionalization, the development of institutions. So if you take the case of China, they've set up a national social security fund. Same thing in France. That's a fairly new institution. And I think one of the trends that will emerge in India, but also will accelerate the growth of the asset management industry, is the development of more institutions investing in the market.
Sunil, coming to you, I think we have seen this interesting trend where a lot of institutional investors who used to normally be investing through or advised by offshore fund managers, now we are seeing a trend, they are coming to domestic onshore fund management teams. How do you see this trend, and why this change in trend now?
Yeah, it's a great question. I think one is very clearly, George had touched upon developed market funds and emerging market funds. So, the investors who wanted to invest were normally investing in countries like India through the emerging market funds. And if you actually see at the start, all emerging markets used to do well at the same time and not do well at the same time. So it made sense if you're bullish on emerging markets to invest in emerging market funds. However, what has happened over the last 5-6 years that even within the emerging markets, the performance has become very divergent. So if India is doing well, Russia does not do well. If China is doing well, Brazil is not doing well, and so on and so forth. So an emerging market investor is finding that even by investing in emerging market, because the performances are so diverse, they ultimately don't end up making too much return. So I think the focus again is slowly starting to shift towards country-specific funds. And that is where onshore fund managers come more into play, because that is where alpha generation becomes that much more important. So if you even take some of the large endowment funds, some of the pension funds, global pension funds, they've started allocating to some extent, country-specific mandates. And very clearly, as we touched upon earlier, that India is a great country in terms of entrepreneur spirit. There are a lot of sectors, companies which are growing from a smaller size to eventually becoming larger. And the onshore fund managers with their reach, we have 30 people working in the investment team, which maybe a global fund, because they track so many countries, might not have the luxury. And being on the ground, being in touch with the management more often, being able to visit their facilities more often. I think that definitely makes it worthwhile for large global funds to look at onshore funds. And I think from our perspective, we feel that that is only going to become stronger as we move ahead.
So our institutional, this is open for anyone, do you see a trend institutional investors investing into the domestic mutual fund schemes? Because with the new advent of the direct schemes in India, where the expenses become very low, do you see a trend? Because if this kind of expertise is available onshore, so will you see a lot of investors if at 30, 40, 50 basis point, I mean, somebody can get the access to the best asset managers in India. So what kind of a trend do you see? Nagu, Harshendu,
It's possible.
It's possible.
Definitely.
So I think it's definitely become a lot more attractive in terms of the economics. I think where the challenges lie are in terms of regulation. So effectively, I think we'll be able to attract self-directed money. You know, institutional clients who are aware and would kind of come in. I think really for significant foreign money to come into India, into the funds, I think the government has to seriously look at ability of Indian funds to register and meet the regulatory requirements of various jurisdictions. And I think if that begins to happen, then that trend will accelerate. Otherwise, you will have a situation where, you know, institutional clients who are looking for these opportunities, they figure this out and they do have ability to come. And as Nishith bhai was saying, it's become a lot more easier for players like that to come into India now.
Thank you. Nishith, anything from your side on this?
I think things are looking better now, and I'm fairly optimistic about the whole thing. Even all the hiccups that we're looking at in next few years, I think if you take 10-year horizon, it will be very different. But at least I think next 3 years also will be very good.
So what I hear is a lot of domestic.
We have to.
Sorry.
I think
I'm sorry.
tax is something that we really need to bring under control. That is the most painful issue at this point in time. And of course, the corporate law things would be changing and there's more business sense on that side. But tax is something that we'll have to quickly address. I do not want to, cause a surprise. Anybody knows how many retrospective amendments happened in last 50, 60 years? 200. Therefore, this whole thing came up, and especially last few years were about over 130 out of 200. And that accelerated in this Vodafone kind of a case. We have learned lessons. So I'm not saying for a moment that what happened and why it happened and therefore, but I think that we have learned a very strong, bitter lesson, and I'm sure we'll be very careful going forward. That's a good sign. So I always see cup half full or half empty, as Modi says, it's always full because half of it is air. But I think that some of these changes quickly we need to bring. AIF, for example, everything came to a standstill. How complicated structuring has become at this point in time just because of one circular that was issued. So if you can bring only one small thing, and this may not be directly your subject, but what has happened, we used to have a practice of putting a law commission to draft and develop a law. That practice has been recently given up. And that is causing a lot of drafting errors and some of the well-intended situations go haywire. But that's not, I think if you all could understand that piece, just a matter of background, because this is more subject on legal side.
Perfect. Taking care of time, I think I'll just have the closing comments from everyone. So Nagu, I think we're in that order.
Again, just to summarize.
Just to know one thing, if you could, because I've been, a lot of institutional investors are here. We are another panel, a banner of institutional investors. So what is the advice if they were to look into, they were to invest into India? How can they do it? And are we making it easy for them? Are we making it difficult for them? So I think just...
Again, as was mentioned earlier, I think the rules and regulations now for registration as an institutional investor are much more simpler. And like I said earlier, there is material upside, we believe, in Indian equities over the next 3 years. And so I think institutional investors should look at every market correction as a great buying opportunity.
Good. Harshendu?
So I'm equally optimistic. I think the investment management ability is of a very high order. I think the commercials have been sorted in favor of the industry. I think as the regulatory environment, especially on the tax side, eases up and I think provides the right framework, I think institutional investors will find a lot of joy coming into India.
I think two advice. One, have a good lawyer on your side.
We have one on the panel.
But somebody who understands the law. If you want to break a law, you must master the law first. Of course, that's a basic saying. But that's on one side. You really, today, importance of lawyers have really increased. I'm not suggesting for a moment that you come to, it's not advertising. Very important thing, whenever we do now new funds, what we do is not look at Indian law alone, okay? Because we have got certain regulatory framework. We also compare with overseas, like AIFMD regulations in Europe or the US and Volcker rule and all this kind of stuff. And we have to move to the best practices. If you can't move to the next ones, but at least best practices that are. So we now do not depend on Indian regulatory environment alone from a strategic perspective and say, oh, here is a PPM, here is a prospectus. Don't look at that. Look at what are the best practices. If Indian standards are all right, it's fine. On that basis, you think, because laws will catch up eventually with whatever the best practices. So that's where your frustration will come, you know. Because you read a law and say, I complied with law, but law changed suddenly because it was not compliant with international practices. I think this is one thing we really need to, you know, go beyond and look at the other things, you know. Sorry.
Sunil, you can also, you have the option of saying.
You need a good lawyer, you need a good fund manager also.
But he has the luxury, he's sitting, he's alone there. You are surrounded by asset managers.
Poor fellow.
But I think from a perspective, you know, this near-term issues, challenges will always be there. India has always shown that they have bounced back from all the challenges. And from our perspective, very clearly, from a $2 trillion to $4 trillion in the next 6 years, definitely looks possible. And if that kind of growth trajectory is there, there is definitely good returns which are going to be made. We have seen that in Japan when it grew. We have seen that in China. We have seen that in the US in the early 1900s when the economy was growing. And there is no reason for us to believe that will not happen in India. So be positive.
George?
So the IMF puts India's potential growth rate at about 6.5%. Right now there's an output gap of around 1.5% in India. So 7-8% growth rates are possible. And obviously India's share of both the global economy and the global equity market capitalization is going to increase significantly over the next 10 to 15 years. So both as a percent of strategic asset allocation, India obviously should be part of the investment opportunity set. And from a tactical basis, the point of entry obviously depends on valuations. But it's very difficult not to be constructive on the Indian economy in the medium term.
Really positive to hear that. I think we have time for just one or two questions. Okay, one question. We have time for just one question, and you have the mic.
Okay. This question is for primarily all of you. See, all of you are here to draw attention to investing in India, whether it be institutional or retail. What is the possibility of the smart people in India, and there are plenty of smart people and with assets, looking at asset diversification about investing outside India? So starting funds which are basically based in India, allowing them to invest outside India, because all of you are here to take money in. How about putting money out? That's the question.
Raghu, you want to?
Well, there's a lot of it already happening in India. We have, in fact, in the asset management industry in India, a lot of fund houses that offer local funds that feed into international funds. So whether it be other emerging markets or developed markets or thematic funds, so that's already an ongoing feature of the local asset management industry.
Oh, it is? Okay.
It is, yeah.
And you have to recognize that in India there are exchange controls, so it makes it difficult, but I think the asset management industry is able through the feeder route to overcome those exchange controls and be able to give investing opportunities to retail investors to invest
because
outside.
India is allowed 125,000 per citizen to allowed to invest outside India. So I was wondering how about having funds in India that people want to diversify their assets and invest outside India with those funds. So you say it's already there. I was not aware of that.
Yeah.
So
that exists.
does Reliance have that?
Yeah, so in fact, I think all of us have. We in fact have launched even a fund which is going to invest in Japanese equities. Even Japanese equities. And I think BlackRock and Templeton already have funds which invest in US equities and some of the other geographies. So those funds are already in place. However, from a domestic investor's perspective, they are right now seeing more growth opportunities in India. So obviously more money is flowing into the India-centric funds than in the global funds.
In fact, regulatory regime will change. We were at 250,000. For some reason, it went down, 125,000. We were all expecting from 250,000 to move to $1 million, and that has happened in Korea, in many other countries. But I expect next couple of years there will be change in mindset, and at the regulators level, and they will begin to allow more investment to happen outside as well.
So gentlemen, thank you very much. I hope you had a good understanding of the way things are going to happen in India. And I think from our perspective, I think we clearly expect, I'm sure, Nishith mentioned in the last conference he had loads of people, 160 people came. And I'm sure a lot of asset managers sitting here will go back with loads of money, from institutional investors back to India. Thank you very much.
Thank you.